Hello, can you hear me, George?
Yes. Good morning, Michael. How are you,
Hi.
sir?
Hi. Oh, you don't have to call me sir. Thank you. Just call me Michael. Yeah, I'm fine. You can hear me okay? Yeah.
Just fine.
Cool, man. Cool. Um. Oh, we got Luke here as well. Cool. Luke, can you hear me? Luke, can you hear me?
I
Luke.
can hear you.
Okay. Cool. 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 Okay. So the way that I've tried to structure today is I've tried to kind of go through aspects of portfolio construction, and I've tried to provide some practical considerations. So there's going to be three aspects to this that I hope you can use what you want from it. You know, if it's useful, use it, and if it's not, just discard it. And yeah, so I I've tried to take some considerations from what Buffett has said, and I've also tried to provide some data to this as well. Okay, so the first one is about what Warren calls the 20 card punch, and in this he talks about if you just have a punch card and you only allow 20 punches, and every time you make a pick on a stock, that's one punch out of your 20, and over your lifetime you only have 20 punches. Now Warren doesn't use this because Warren himself, if you actually look at his trades in 1 year, he's doing much more than this. But this is a framework to help us think about the importance when investing of looking for really looking about the selection criteria. So within this, it's really about you being quite selective because you only have a certain amount of choices to go with. Also, I believe very much that it's important to space out your investments as well, because I see this in my own service, and I see this across the site as well from comments with the editors and stuff like that. When the markets are going up, people have a higher inclination to invest. And when markets kind of go down, people kind of take a watch and see step. What's happening in those scenarios is that you end up putting a lot of money into a stock or into the portfolio at a certain time, and people's appetites comes down when the market slows down a bit. Now, I've often said that no matter how good the stock, it can be like the world's greatest stock, it can be Nvidia, it can be whatever. No stock ever goes up in a straight line. It goes up, it takes a breather, it comes down, it goes up. So, and it does works on the other side of the equation as well. Just because a stock is going down, 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 and it kind of goes up a little bit, doesn't mean that everything is hunky dory. It could be just that the market in the same way doesn't come down in a straight line, or it doesn't go up in a straight line. And I think that this within this 20 card punch, I think it's quite important to think about these four considerations. So the first one that I think about, I always give this analogy of when it comes to buying a house. When you're buying into a stock, I believe that you should do the same amount of research that you do when it comes to buying a house. So when it comes to buying a house, you will often, I don't know if you have people have bought houses, but you'll often kind of go a few times to the neighborhood at different times. Like you go in the morning, you go in the evening. You want to get a feel for what's happening there at different times of day. So you do a research, you compare with the neighbors, how much the neighbors' properties are going for. So it's a lengthy journey. Now, if you're doing this all the time, and this is like second nature to you, you still need to go through this process. So even if you bought a few houses in your time, you still kind of, even if you know that neighborhood really, really well, you still do some kind of due diligence, right? You go into the property, you kind of move around things just to make sure that it is what it is. Because sometimes things look a certain way, and actually, when you've got in there and you've actually gone through the motions of it, it actually looks slightly different. So this is the important thing, which is really doing that due diligence. And the second thing that I talk about every single week here is spend 5 minutes just going through the balance sheet. And I've spoken about that at length. Just look at the cash and just look at the debt. You don't need to overcomplicate. You can look at other things, but just simple. Look at how much cash it has and look how much debt it has. Now, if the business has, $100 of cash and $100 of debt, it's okay. It's kind of even. It's out. It's fine. That they can work themselves out. But if the business has, like, for example, $100 in cash or 100 million, whatever, and like 400 or so million of debt, if it has more than 4 times the amount of debt than it has cash, then I would say, whoa, something is not looking quite right here. There's, as a rule of thumb, I kind of don't mind if it's 1 to 2, meaning like $1 of cash to $2 of debt. That's kind of at the limit of what I think is suitable. Once you get to 3 times leverage, it kind of gets a bit messy, depending on the business. If it's a business is a really stable business, and by that I mean a business that has been around for quite a few cycles, not something that's been around for, let's say, 5 years, but a business that's been around for, let's say, 10, 15 years, and it's been through different economic cycles, and it's a really stable business. For example, the ones I'm thinking about is here's a subscription business, for example, broadband providers or like streaming services. This is the kind of thing people don't really churn out of that much. Those businesses can have quite a lot more debt on them, and other businesses where you have a discretion, where you kind of may use that service once and not use it for a few months, probably you shouldn't really be looking at those businesses to have a lot of leverage. So number one, spend a few minutes, do the due diligence of the company. Number two, look at the balance sheet. You don't need to make this very complicated, but just, look at how much cash and how much debt it has. The other thing is, I believe that this 20 card punch that Warren gives you is really to prevent you from over trading. And over trading happens a lot when the markets are moving in one direction or another, and you end up kind of over committing yourself, and you think, oh, I've got this, and I say space this out. Don't make too many decisions within a 4-week period, because the markets can change quite a lot. So it's really, I find it quite helpful to just space that out a little bit. And the other thing, and finally, is just tying this together, is don't rush. It's okay to average into a position, space it out 4, 5, 6 weeks each time. I've spoken to Luke about this in the past, and I think, put like, say, like a third of your position in, then kind of wait like 4 or 6 weeks, put another third, and then another 4 or 6 weeks to put the last third in, because at least this way you've been through at least one quarterly result, and you kind of seen, does this tally up with what I thought it was going to be coming out? So the more time you spend with the company, the more you've lived with that, the more you understand the company, and you get a feel for things, how it's performing in certain, how the company is performing over time. You kind of get a feel for it. Yeah. And finally, this is something that I think is important. When it comes to diversification, we often think about businesses being diversified. For example, if you're looking at let's say a fintech like Block, you probably think, oh, that's quite diversified and hasn't got much to do with something like, say, like Farfetch, and you think that you got diversification there, but those businesses in essence are really tied up to interest rates, and you want to be in businesses that have different sensitivities to the interest rate movements. The way that I tried my best to structure that is I have, let's say, a dividend stock like Arch Resources. That's kind of like, it's a quote unquote a value stock. So it's kind of, you're not paying a large multiple for those free cash flows. So if the interest rates go up, that means that those businesses, the kind of quote unquote value stocks, kind of tend to do better. And if interest rates come back down, your long duration assets tend to do better, sometimes called growth stocks. So if you think about it, since about 2012, 2013, interest rates have been really quite low, and this has allowed a lot of businesses, like the growth businesses, to do really, really well because interest rates were really, really low. So what's happened in this environment is that the cost to borrow is low, so you can kind of aggressively expand your business because it doesn't cost you much to borrow that capital. You kind of borrow it at low rates and you can really grow because it doesn't matter. It's quite cheap to borrow the capital. But when interest rates go higher, and you have to think a little bit more about the cost of that capital, you have to think about it. You have to think, okay, I have to either pay out interest 5%, or can I guarantee really that the investments that I'm making in this business are going to deliver more than 5% to my business in terms of earnings in the future. And at 5%, the person can kind of think, oh, this or that. But once the interest rates come, like say 5.5, 6%, those hurdles become quite high. And at that point, the cost of capital becomes quite high, and it's not really conducive to being a growth business. So again, I think when it comes to looking at the portfolio, I think it's helpful to look at different types of value and growth businesses. And also, I believe it's worthwhile having some large caps and some small caps, because in a period of time, let's say 3-6 months or something like that, there are certain factors in the market that kind of go in a certain way, and you want to remain sane in that period. So, for example, I have Google in the portfolio, have Broadcom. These are like Palo Alto Networks. These are kind of large cap businesses. And when the markets are kind of edgy, that provides me some sanity, because those stocks don't typically come down as much. But when you have, let's say, some kind of Palantir and some other kind of smaller caps, those in a day, they can be down 10% in just normal course of business, but that's quite painful. So I suggest have different growth and different value stocks, have 1 or 2 dividend names, and have a spread in terms of the size of the company. I think that is helpful, because everything that I'm trying to provide here is about having staying power and, not kind of getting emotional at a difficult time, because the worst thing you want is to have to withdraw capital from your portfolio when the market's in a downturn. I've often found that the time you need cash is also happens to be when the market is in a sell-off mood, and you want to have, different kind of bullets in the portfolio that you can kind of use at different points in time. So this is something that I think is important to think about when it comes to structuring the portfolio. The other thing that I believe is quite helpful is to have a bit of a reality check when it comes to what is likely. So last week I talked about Michael Mobosin's base rates, and Michael Mobosin from Credit Suisse has written a lot about base rates. So base rate is like, what is the typical performance of certain, like a universe of stocks. So you can also look to baseball or cricket or whatever, or basketball or whatever. But the base rate is like, what's the typical aspect of this? And if you look at that, the vast majority of businesses will not compound at 35% for 5 years. In fact, he puts that down to 1%. 1% of businesses are able to compound at 35% for 5 years. That's a really, really small number. That means 99% are not able to do that. That's basically everything. Is very rarely. There are a few cases, you obviously have your Amazons and whatever, but those are the exceptions. And trying to get the lottery ticket of 1% is really, really difficult. But actually, the vast majority of businesses compound at much slower rates, let's say 10 to 15%. So have a realistic expectation of what your business can do. So yes, you want to be patient. And when you invest, you kind of want to give that. I believe it's worthwhile to give a business at least a year so you can kind of see how it's developing. But also, you don't want to fall in love with your businesses, because the vast majority of businesses, and I would include this in Amazon and even Google, are cyclical. We've kind of been led to believe that these are kind of secular growth stories, and because Wall Street loves spinning those stories. But even look at the chart of, let's say, Amazon, it's quite cyclical and dependent on how the economy is performing. So I suggest, most people that I talk to, they have very short time horizon. So that's probably a wasted message. But, something like a year to 2 years is a reasonable time horizon, because longer than that, I think that you've either captured the alpha, you have to actually capture the idea, the hypothesis working out, the re-rating, the change of the perception of that stock, or it hasn't worked out. I think that, but the vast majority of people that I talk to have very short time horizons. So this is a wasted message. But having, giving yourself time to stay with the business, I think also has a lot of merit, because the market can be really crazy in a short period of time. And if you feel like you're missing out on something and you're kind of running from one ship to the next, I think that that's kind of causes a lot of problems. And for me, I put this safeguard that I don't want to be changing out of a position in less than a year. After a year, I think that, you have to be frank and say, okay, it didn't work out, and, move on. But give that business time to show itself, And finally, one last thing, I believe that is quite helpful to look on the proxy statement. This doesn't take a long time. Just on the proxy statement is a statement that's filed once a year, and it just tells you how much management owns of that company. And, it's not the only indicator that something's going to do quite well. For example, Tim Cook probably has very little ownership of Apple. In fact, the irony was that Steve Jobs actually didn't have that much ownership of Apple, because he sold most of it when he went to Pixar. So, there are kind of stories for everything. But typically, if it's an owner of the business, it doesn't need to be, like, say, for example, the founder, but someone that has, some stake in the business, and they've been around for a little bit of time. They're just not kind of what they call mercenary CEO. A mercenary CEO just hired to stay around for 2-3 years, and then they kind of go off to do another task. If they kind of stick around the business for some time, I think that's kind of, all you're trying to do is put the probabilities on your side. If the CEO has, some stake in the business, I think that helps a little bit in terms of, putting the chips on your side, so that that they're highly motivated to deliver long-term intrinsic value. And yeah, that's my spiel for today. If you guys have any questions, I'll be more than happy to take them.
I did listen to every word you say, so I don't want you to think that my question is saying like I didn't hear anything. But isn't there times when, for example, when Netflix during COVID went all the way to 600, moved all the way down to 169? That would be a good time, I would think. I was thinking of it, didn't do it, but just buy a bunch at that moment and not do the third and wait 2 weeks and that. In other words, is there some what's the word?
The dip opportunities.
Yeah, take advantage of opportunities, rare moments, and jump on a good opportunity.
So 2 aspects. First, you are looking in hindsight to see that it performed well. So, like, in hindsight, it's one thing, okay? Most people, you can't invest in hindsight, right? The second thing is you become overwhelmed with that position. It's just human nature. If you go all in and you mistime that entry, like, you can just kind of you become kind of like, okay, it's going down further. I'm already down 30%. Like, what do I do? Do I get out? Oh, yeah, you kind of get caught up in your emotions. But if you put, let's say, a third of a position and it's kind of down a little bit cheaper, you have the ability, you left yourself a room to average in a little bit further. So what I always describe is, George, I'm always trying to explain how to stay in the business of investing. That's what I'm trying to explain. How to not make yourself your worst enemy, what's interesting? Okay, so when it shouldn't be like this, but when the portfolio is not doing very well, I kind of feel like sleepless nights, and I kind of get all edgy and crabby, and that's actually, ironically, cutting away at my lifespan. I'm a big believer that, if you have a good well-being and you eat well and you're healthy, you can live longer. And, what you're trying to do is, if you can stay around for longer and you can compound that capital for a longer period of time, you have a bigger pot of money at the other side, the other side. Now, if you kind of put quite a large position in Netflix, yes, you, in hindsight, could say it worked out quite well, but there are many businesses where it kind of goes down and then it goes on even further. Look, for example, at Meta. Look at Meta's, I know now Meta's up, but Meta has had quite a few quarters where, like, I think going back now, 2 years, so I can't really remember. I have to look at the share price. But it's like one quarter was down like 20%, and next quarter was down 30%. And you're like, oh my God. And if you go down, when it got down 20%, and then you kind of get really that kind of feeling and that tightness in your chest, and then you kind of, you're just running around, and you're not allowing yourself to stay invested in this business. Take it like a business. And the way that I think about it is really try, whenever possible, to align investing with your own well-being and personality. Try to make it congruent with you. So we all want, I like, my God, I got my family, everything. I want to like make it as well. But try and make it so that it's working along with your life, not kind of at heads with your life. Because if you kind of go all in and then it's not working out, and you just kind of get yourself into a state of panic. And then if you just had waited 6 months, things are stabilized. Do you know what I mean?
I understand, but I do at the same time, I think there's opportunities. Let's go back decades when Coca-Cola changed its formula and the stock dropped like 25% overnight practically. Or, for example, PG&E, they had the wildfires, they declared bankruptcy, and I made 40% in 6 months because it went bankrupt, and then the stock went down to $6. This was a $50, and it's a utility. So I put a whole lot of money in, and at one time, and it worked out. To me, it seems like it's very rare, but there's exceptions.
Yeah, those are very high risk, high return opportunities. And what I think is really important is to get away from those lottery tickets. As I said many times, that it's much better to go for a 15% compounding than to try to go for a 25. It's really about the boring. The more boring this is, the more stable it is. You actually feel lighter because you put this guard that you're gonna. This is how it's this steady compounding. And I know you played around with like a calculator and you see this, but if you're compounding at a certain rate and you have one bad year, it really slows down everything, and then it takes the clock back such a long time, and you're kind of like, oh my God, I've got to go back 5-6 years. It's going to take me a long time, and it's much better to kind of try and do it slow. Everyone can look in hindsight, and I can tell you that in 2002, Apple was trading as a net. That means that it was trading for just the cash on its balance sheet. And I can say that if I invested in Apple then and held it until now, it would have been the best return in the earth. But the kind of person that bought Apple in 2002 when it was a net, they probably made 25 or 30%, and they sold. And then they didn't capture that boring return that would have compounded much slower, but would have allowed the person to keep going and going and going. Now, again, I'm self-contradicting myself because I'm looking back and I'm pinpointing that story to you. But what I'm sure, Apple is an exception, and in fact, when you look at these businesses, I was kind of looking this up, right? So here's the irony, okay? So I'm going to name a few businesses, okay? I'm going to say to you, there was, in the year 2000, the top 5 businesses were Intel, ExxonMobil, Cisco, General Electric, and Microsoft, okay? So, like, those are the top 5 businesses. And of those top 5 businesses, only Microsoft is, like, still a leader today. So, you can look and you can say, oh, if I'd gone with PG&E and like this and that, but capitalism is brutal. It's really, really brutal. But I believe to get dislodged from these kind of risky strategies, and I run a service, and it's really difficult to get people to think in this manner that the slow and steady is the way to go. And I don't know, I also have to kind of try and be a good mentor, and I like explain to people that. And I spend a lot of time thinking about that. I have to kind of, I also like it very much when, things work out positively and it works out in a short period of time and it feels great. And I'm like, yeah. But that's not real life. And that's not a process that can be repeated consistently. Now, the venture capital model is you have, let's say, 100 stocks, and hopefully that one stock will beat the whole portfolio. But that venture capitalist, they will probably wait with that stock 5, 7, 8 years. So yes, that was the one lucky ticket, but they stayed with that process. Now, those high risk returns, they're quite rare, and unless a person has the structure that can stay with that stock for, let's say, a good number of years, you're kind of cutting it short. Does that make sense?
Yes. Thank you.
Yeah, I mean, it's a really, I mean, I think about what you say a lot, because this is something that I've also been on that journey. I follow a lot of stocks, and I can see a lot of moving things all the time. And I also think about that, there are times where it looks like something looks crazy cheap. It's like, oh God, this cannot be. But the market, apart from on very irregular periods, the market generally is quite good at discerning what's happening and the risk. There are periods where things kind of go a bit crazy, and we can all say in hindsight, oh, if I invested on the 22nd of April of 2020 when COVID hit, that would have been like a great time. But that's not real life, over time, you kind of have positions that work out, and it's not that you have all the capital to dispose in that day, and yes, you can walk around with, let's say, 10-15% cash position and go in at that point in time, but that's a theoretical exercise. What you're trying to do is reproduce those returns over a long period of time, and as I said as well before, try and make it aligned with your personality. Do you know what I mean? So that you're not kind of getting yourself like, okay, this has to work out, and it's not working out. Like, what's going on? Does someone know something I don't? You know what I mean?
Right.
Man,
Thank you.
it's a really valid
Thank you.
question. And I mean, I do think about this, and
Okay.
yeah, there are times when things look like, okay, this shouldn't be like that, but I think that slow and steady is also worthwhile thinking about.
And I get what you're saying. You're saying it, and it takes discipline, and you who look at stocks all the time and know so much more than the average person like myself, then you would see those opportunities. So if anyone would be able to see those opportunities, it would be you. And even you were saying, look, slow and steady wins the race.
Yeah, and I always think about, I always go back to Warren. So everyone knows about like Warren's performance, but if Berkshire Hathaway was to sell off now 99% since his performance, since his inception in 1956, since the Berkshire inception, if it was to sell off 99%, he would have still outperformed the S&P by a few percentage points. And he hasn't, if you look at his performance over the last 53 years, it's kind of around 20%. Okay, he's one in more than 7 billion people. He's like the exception. But the message there is really that boring, just continuous going forward. Now, obviously, Warren is exceptional, and like no one else is going to be like him again. But there's lesson there is really, not blowing yourself up. Again, like you have like one bad year and it puts you back so many years to kind of get back on track. Do you know what I mean?
Yes. Thank you.
Do you guys have any other questions?
I have. Can I ask one more question? Yahoo Finance, is that a good place to go to find? Is that accurate? Like when it says the PE, or for example, the dividend, earnings per share, is that accurate? Just to look at Yahoo Finance.
So, not really.
Okay.
There are a few things. First, I'll take the easy one, the dividend. So some companies may have just stopped doing the dividend. Okay, for whatever reason, they kind of had that one last dividend, which was high, and then they stopped doing the dividend because they might do share buybacks or something else. So that's one thing. Second thing, for example, Arch's dividend on, I suspect, because I saw on Seeking Alpha, but I suspect Yahoo Finance will be the same. Arch's dividend is like really, really low because they have a variable dividend. So they have a fixed dividend, which is just a peanut, and then they have a variable dividend, and the variable dividend is not guaranteed. So they it doesn't show up on the Yahoo Finance. I on Seeking Alpha, but I suspect to be the same one on Yahoo Finance. The other thing with the price to earnings multiple is that you have to think about certain businesses are more aggressive than others at capitalizing their expenses. By that, I mean that certain businesses will be likely to will be very aggressive with the way that they invest into their business, so they don't record that expense, or they may have a lot of capex, capital expenditure. So you may have a business like, say, a semiconductor business that has a very, very, very low PE, but that's because they're having to take a bulk of their earnings and reinvest to the next cycle to build the next fab. So sadly, I think that it's not a very good way to think about it.
Okay, thank you.
Luke, did you have a question?
Yeah, I was observing how you trade or invest. When I first joined, I think it was January last year, or maybe even the year before. And now, the portfolio has improved a lot. And I know that you made quite a few errors on the entry points in the past. What have you changed recently that I see that the portfolio is doing much better? I mean, the market is better too, but for those sectors. But what have you?
This is a very good question. This is a super question. So this is what I was telling you before about the different sensitivities to the interest rate. Before I was, this business is different to that one and this and that, and they were all growth stocks. But I didn't know that, until I went through that shock of the interest rates coming up. I didn't see, that's a really good question. I didn't see the correlation. That's why now I'm trying to have some kind of even I know no one likes it, but that One Oak, which is like a dividend stock, it's given me around 9% return since 6-7 months. So it's not like heroic. I'm not going to say it's a heroic return, but it's okay. That's what I'm trying to describe. It's like you have these kind of dividend boring stocks and you have some kind of growth stocks because you don't know how the market's going to go. If the market kind of goes in risk on movement, something like, say, like Palantir is just going to go to the roof. And you don't want to have all your eggs in that, because that's what that's the importance of going through different cycles. And what Charlie Munger says, that the way you should have a broker is you should get a very, very old broker, because that broker has gone through a lot of different cycles and they've seen a lot of different things and they're a bit more experienced. And the way you should have a doctor is one that's straight out of university, has all the medical knowledge and hasn't got any kind of bad faults to them. So in the different professions, there are advantages to being old, and this is one of them. So the longer you've been doing this, you've been through those cycles. You say, okay, this is how it happens in the bull market. This happened in the bear market, and since 2019, we've been through the bull and the bear, really. And it's like, if you look back to the year 2000, from 2000 to 2010, that was like 10 years. You went through the bull market and then you went through the bear market. That was like 10 years. And we went through all of that in a really short space of time. And the experience that I picked up and others have picked up is invaluable, because now you're like, oh, okay, yeah, the markets are going up, but I don't need to chase that, because I know that at the moment's notice, the Fed says something and it's all risk off, and I don't want to be in that position again, ever again. So I've tried to have different kind of value stocks and dividend stocks, just different things, because I want to just be able to stay in this game.
So would you say that before you had more risky technical stocks?
Yeah, absolutely. Okay, guys. Thank you so much for coming. I really appreciate it. I mean, I really appreciate you guys coming on, asking these questions. And I really, like George, you were saying before about that question about, like, it is sometimes worthwhile to kind of go in. It's such a valuable question. I'll try and kind of talk about that more next week, because I'll come back with some more thoughts on that. I think that's a really good question.
Okay. Thank you very much, Michael.
Thank you, guys. Thank you so much, guys. See you soon.
Okay.
Bye-bye.
Good night.
Bye-bye.